Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of the Throwback Rule, which has become a more common conversation as of lately, with the Internal Revenue Service really drilling down foreign trust reporting, income tax, things of that nature. So typically the Throwback Tax Rule or Throwback Rule applies to foreign non-grantor trusts. So let's assume, for purposes of this brief summary, it's a foreign trust, it doesn't meet the court or the control test, etc., and there's U.S. beneficiaries. When you have a non-grantor trust, it gets taxed differently than a grantor trust. Grantor owner gets taxed with a non-grantor trust, the beneficiaries who get taxed, or the trust if it's not distributed out. Okay, it's a separate entity. DNI and UNI are the two key acronyms when you're dealing with the Throwback Rule. DNI is distributable net income. UNI is undistributed net income, right? Normally what will happen is when the trust is doing its accounting, it wants to avoid keeping income at the trust level because it tends to be higher than when it's distributed out to the beneficiaries, depending on the income level of the beneficiary. So they'll do a DNI, sort of like a business takes a deduction, trust takes a deduction, and sometimes in a perfect world, depending on the complexity of the trust, you want to get all that money out, but not always, okay? So when you have the DNI, if it's not distributed, I think it's within 65 days, then what happens is it turns into UNI, which is undistributed net income, right? Pretty common sense, even for the IRS. And so with UNI, what will happen is it'll get distributed in a subsequent year. And so what happens when that DNI is turned into UNI and it's distributed in a subsequent year? Well, unfortunately, that's when the Throwback Rule takes effect. And what will happen is the Internal Revenue Service wants to kind of strip away any benefit that the beneficiary may have had, depending on what the income category would have been back in the day. Instead of formally penalizing you, they do a kind of roundabout, weaselly sort of way, and instead they hit you with interest. It's like what they do with the PFIC. You get taxed at the highest income tax rate, but then you've got a daily interest rate depending on how long it's been sitting in there and the value of the PFIC. It could be extensive. Same concept with the Throwback Rule. And so, if they were going to receive capital gains or qualified dividends, then they will oftentimes will lose the benefit due to the interest. DNI gets complicated when you have foreign non-grantor trust. It tends to include capital gains. On the domestic side, it does not, for the most part. Always exceptions, exclusions, and limitations, right? The three common important words when you're dealing with international tax. When it comes to the UNI in subsequent years, it sort of operates like E&P, right? The DNI comes out first, and then any additional is UNI, and then it turns back into principal, which isn't taxed. If you've got a foreign non-grantor trust, it's important that you work. If you're in California, go to the bar website, seek out a board-certified estate planning attorney, not just some bozo attorney that's going to run around claiming that they're an expert, right? You want to go to someone who's board certified in estate planning, work with them, go through the basics with them, let them see the trust, if it's simple and complex and what needs to be done, so that it's not something you're worried about in the future and your trust ends up paying significant more tax than it may need to do. Okay, if you're out of compliance for the reporting aspect, like 3520, 3520A, then you'll want to consider one of the disclosure programs. Back in 2018, I believe, it was one of the LB&I compliance programs, 3520, 3520A, specifically for trusts, and the IRS has really been enforcing that as of lately, significant fines and penalties upwards of 35%. There's various programs you can use to get into compliance. They're collectively referred to as offshore disclosure. You've got the voluntary disclosure program if you're willful or just can't certify under penalty of perjury that you're non-willful. Otherwise, you've got programs that are for non-willful, and there's more to choose from. There's a streamlined program, there's reasonable cause, and there's delinquency, although delinquency was modified back in November of 2020. We have lots of free information available on our main website and our sub-websites. You can always reach out, schedule a reduced fee initial consultation if it's something appropriate to what we do. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of the day.